Some discussions may touch on legal and tax topics, but nothing contained in these episodes should be considered tax or legal advice. David and I are not accountants nor licensed attorneys. Please consult with your tax and legal professionals for advice on your own unique situations.
Hey, good morning, everybody, and welcome to the latest episode of the Did It Close podcast. Today, we're excited to be joining and to be talking about 1031s, DSTs, and 721s with our good friend and guest, Dave
Thank you,
Bulger
Brian.
with
Good
Perch
morning.
Wealth. So, Dave, welcome to the show. How are you doing today, and where are you calling in
both.
from? It looks sunny
I'm in
and
South
warm
Florida.
where you
I'm
are.
in
So.
Ocean Ridge, Florida, and appreciate being on today. And thank you, Brian, and thank you, David.
No, thank you for coming on. And Dave and I worked well together. We've had a couple clients. Is kind of how we met, and we'll kind of dive into that because I think people have heard of the world of 1031s, which I think we'll probably start off with and explain what that is, just for those that aren't familiar. But then how they can use these products like DSTs and 721s to kind of really kind of expand. So, but before we jump into all that, Dave, give us a little background about yourself. Where are you from? What kind of what you do at a high level as we dive into it.
Thank you,
Just
Brian.
tell us a little bit about yourself.
I mentioned I'm in South Florida, Ocean Ridge, and I represent a firm out of Southern California called Perch Wealth, and we are focused exclusively on helping investors who are either considering a 1031 exchange or have decided to move forward, and we can help them with their replacement property options. There's a couple of different paths you can take. And so, I sort of describe myself as a wealth advisor, but more specifically a 1031 exchange specialist. And I've been in the securities industry for over 25 years. I'd say probably the last 7 or 8 years more exclusively on 1031s. Prior to that, a lot of experience with sort of securitizing and distribution on other alternative investments, primarily real estate deals, some real estate investment trusts, some BDCs, some private placements, all what we used to call AI. That used to mean alternative investment. It means something very different now, of course. But anyway, but my path kept getting more and more narrow into the 1031 space. And so, as I said, really my focus has been, almost exclusively on this, what we call securitized 1031 exchanges, which most specifically or most commonly would be the DST, which I know we'll get into in a few minutes. But to your other question, kind of background where I'm from. So my wife and I, we've been here in Florida now for over 20 years, 25 years, really. Both of us are from Pittsburgh. So, while I'm here in Florida and we have 3 kids, a son and 2 daughters, our family and roots and a lot of our friends are still back in Pittsburgh. So we do get up there fairly often, both for work and then just also for family and friends. And I still sneak up to catch a couple Steeler games most years as well.
Brian, let's hear that.
We talked about getting together. We're gonna have to have David Dirkschneider in for a Steeler game. We'll have to all get together. So, yeah, we got Aaron Rodgers this year, so we'll get to see his retirement tour here. So, but Dave, I guess as we start off and kind of get into this, I know David and I do some of this work, but you really do it every single day. So, for those that aren't familiar, can you give us a high level of like what is a 1031, some of the requirements that go along with that, and I think that will serve as a nice primer as we dive into
I always like to describe the 1031
avenues.
Exchange, in my view, is one of the most powerful tax planning vehicles and estate planning vehicles that the IRS allows. I guess in simplest terms, it is a tax code. The 1031 is simply a section of the tax code that allows investors who are selling investment property to defer the capital gains by reinvesting the proceeds of the sale into what the IRS calls a like-kind property of equal or greater value. And that leads to there's a little bit of, I don't want to say confusion, but maybe misunderstanding. Like-kind does not mean you have to buy a property in the same asset class or sector. Meaning, if an investor is selling an industrial property or a multifamily property or a retail, as long as it is an investment property, when they sell it, they can buy another investment property defined by the IRS as property used for productive use, they can defer the capital gains taxes. Well, the reason that's significant, in my view, is because depending upon the size of the gain, and we work with a lot of investors that, maybe they bought a property 10, 20, even 30 years ago, they can be sitting on substantial capital gains. Someone bought a warehouse for $1 million 20 years ago. They may be selling it for $2 million today. And hey, that's wonderful, but you now have a $1 million capital gains tax. So depending on what state you're living in, even here in Florida, we don't have a state capital gains tax. You're looking at roughly 24% when you consider the federal capital gains tax and the net income tax. In Pennsylvania, you can add another 3 or 3.07, I believe. So, and that $1 million gain, hey, congratulations, you've made a great investment, but you're writing a check to the IRS for about $270,000 if you don't exercise a 1031. If you do, you can defer that capital gain. And, I mentioned from an estate planning standpoint, the IRS allows you to defer that indefinitely, meaning for the rest of your life, if you choose to, meaning your beneficiaries, your children or whomever would get a full step up in basis. In other words, that capital gain would completely go away upon death.
So I guess maybe to kind of put
Yes.
some terms. So like in that same example, I bought a warehouse for $1 million, right? I sell it for $2 million. Instead of paying that, I can 1031 into, let's just say, let's say a retail center,
Correct.
because it's still like kind exchange, right? And I buy that for $2 million.
Yeah.
And unfortunately, I pass away the day after I buy it, right? So, but then what you're saying is my heirs, if they would
That's
sell it
exactly
a
right.
month later, they
No,
actually
you
get
described
stepped
it
up in
perfectly.
basis
That's
to $2
exactly
million.
what happens.
Is that correct,
they would
Dave?
get
Or
a
did I
step
have
up
that?
in basis,
Okay.
meaning their new basis would be fair market value on the day of death. So it allows that tax deferral. It allows that the capital gain, and if there's any if they've been depreciating that property, any recapture tax, all of that is then deferred. And in the example you gave, that's exactly right. The heirs or the beneficiaries would get that step up. And so anyway.
You hit on something I was going to ask you, actually, that you said it there. And that's depreciation. Because you said I bought
Yeah.
something for $1 million and I owned it for a while and I depreciated it down to
It
500,000.
does.
Does the
So the
1031
1031
eliminate
actually
depreciation recapture?
allows the deferral of 4 different taxes. The federal capital gains tax, which is typically 20% if you're in the highest bracket. Any state capital gains tax, which the majority of the states do have. I mentioned Florida doesn't, but most do. The 3.8% net income tax. And then, as you said, recapture. If you've been depreciating that property upon sale, normally you're paying 25% recapture. All 4 of those taxes are deferred in the case of or when the investor chooses to execute a 1031 exchange.
I know Pennsylvania was actually one of the last states to actually recognize a 1031 for state income taxes. Do you know any states that do not
Yeah,
recognize it left? I
that's
know like
exactly right.
Pennsylvania was like
Starting
2 years
January
ago
1st
or
of
3 years ago, I
2023,
believe.
I believe it was called Act 53. It allowed Pennsylvania to now conform with the federal tax code for 1031 exchanges. And to your question, I believe Pennsylvania was the last state to conform. But it now is. So for the last 2.5 years, you get the full tax. You could still do an exchange. However, you still had to pay the Pennsylvania state capital gains tax. That is no longer the case. So it can comply. Now, in order to do this, though, the IRS, they do set up a number of very specific boxes to check or hurdles that you have to leap over to do a successful exchange. I'd be glad to comment on a couple of those if that would be helpful.
One thing I'll say first, because I think that'd be good, is, some people watching this may not know there's a big difference between deferral and elimination. This does not get rid of taxes. This just defers them. You're kicking the can down the street.
That is exactly right. So the 1031, and that's the expression I always use, you're kicking the can down the road. The gain is still on the books. You are strictly deferring that capital gain. However, the elimination does exist upon death. So what we had mentioned earlier, the step up in basis, that does eliminate the gain. So during the life of the investor, they can defer, again, indefinitely, but upon death, they do have the elimination of all gain. If they, now, not every investor can do that. Some people sell and for various reasons, they may need the proceeds. That's completely fine. But if investor does not need the proceeds, then we would at least suggest considering the benefits of the exchange.
Yeah, for estate planning purposes, that's the best case scenario. I mean, you don't need the money right now, and you plan on passing it on anyways. Then wait till after you pass away and step up.
Yeah, that's exactly right.
David, I'm sorry, Dave. We got Dave and David. I've got to be careful here. If you could go in, actually, if you want to touch on a couple of things. One, the requirements for the IRS, and then two, in that your example earlier, I had a property that was worth $1 million. Let's just pretend I didn't have any depreciation. We won't complicate this, and I sell it for $2 million. I got to take 200,000 out because I got to pay for college, and college is getting really expensive nowadays. Can you just kind of go into the different regulations and what's possible in that scenario?
You bought a property for $1 million, you sell it for $2 million. There's a couple of things the IRS requires. They do require for a full exchange that you replace equal or greater of the sale price. In that example, $2 million. So what does that mean if there's debt on the property? Maybe you have a mortgage to pay off at closing. Maybe if there's $500,000 of that $2 million as a note. Well, you pay that off at closing. You still have to get to the $2 million number. That's the number so you have to replace equal or greater of closing, and that's inclusive of any equity in the deal and then also any debt. Similarly, any basis in gain. We talk to some people and they say, well, wait a minute, I bought it for $1 million, I'm selling for $2 million. I only need to replace the $1 million in gain. And unfortunately, that's not the case. So it would be that in that example, to do a full exchange, $2 million, inclusive of equity and debt, and inclusive of both your basis and gain. And then to your point, well, what happens if you just want to take something off the table, which is very common, very frequently we see that, and we simply call that a partial exchange. You're absolutely free to do that. If you want to take 100 or 200 or whatever off the table just for cash, that's great. However, you will be paying taxes on anything that you take out of the deal. So in that example, let's say you sell for $2 million, you take 200 off the table and you replace $1.8 million. So you've got $1.8 million in your exchange that you've protected. 200 comes out in cash. That's fine, but you will be paying taxes on that 200. Very common. We just call that a partial exchange. And then the other pieces to this are some of the timeline and replacement requirements from the IRS. On the day you sell the property, a couple things have to occur. First of all, you cannot touch the proceeds. If you take what the IRS calls constructive receipt of the proceeds, meaning you take the cash, it blows up the exchange. So you must escrow the proceeds with what's known as a qualified intermediary or a QI. So even if you're just thinking about executing an exchange, you have to escrow, because if you don't, you're out of luck. You're too late. And then from the day of sale, you then have 45 days to identify a replacement property, and then 180 days to actually close on that property. Those timelines run simultaneously. So that 45 days can move quickly. It can be stressful if you're trying to find and identify a property. If there's debt to replace, you have to secure financing, you have to secure a closing. So it can be stressful. I believe it's worth it because of the tax benefit, but you do have kind of a deadline.
Start working ahead of time.
Well, David, that's what we always try to emphasize, is the importance of having everything, if possible, lined up, prior to closing in terms of your QI. And, ideally you've already identified a couple of properties. And then that's the other thing, is the actual identification. The IRS allows you to identify, there's actually two ways to do this. You can identify 3 properties of any value, or you can identify more than 3 if the cumulative value doesn't double the sale price. That's called the 200% rule. I'm getting into the minutia. I don't mean to do that. My point.
You're good.
Yeah.
No, You're actually you're hitting on something I was going to ask you, and there's actually and do you know some of the other identification, because we deal with this when it comes to replacing
No, that's
scattered
great,
sites.
because you're right. Then you have the
Dave, I was going to ask you all these
95% rule. There's
questions
actually
anyway,
three
so please
different
hit it.
replacement
So
rules. But the most common, though, we see is the 3 property rule, and then the 200% rule. But you have to be very specific when you identify. There's a formal process. You don't just say, "Oh, hey, I identify that property." You have to provide street address and dollar amount. And that's another role that the QI plays, is helping with the identification. And if you exceed 200%, if you sell a property for $1 million, you can identify up to $2 million in replacement beyond the 3 properties. Anything above that, though, again, is a red flag and can blow the deal with the IRS. Yeah.
can you just you mentioned the
I will.
95% rule, which
And by
I've
the
actually
way,
had to deal with. So
you're one of
could
the
you just
few people in
elaborate
the
on that
country
just a
that
little
has.
bit,
It's
Dave?
very rare. It's extremely rare, the 95% rule. But when you have scattered site, that's really when it comes into play. That allows you to identify any number of properties of any value. So you can identify more than 3, and you can go over 200%. However, where it becomes tricky is the IRS requires that you actually close on 95% of those properties. So you better be very confident that you're going to close. If you go that path, it's doable. You've done it, but it's not common. But yes, the IRS actually allows all 3 of those as replacement options.
At least 95%. So you can close on all of them.
You got it. Yes. Yep.
So that's what probably what most people do, is they make an offer on another scattered site portfolio with one seller, and it makes it a lot easier to ensure that you're getting all of them.
That's right. That's exactly right. Yeah.
Dave, before we jump off, because I think this will be a good primer. One question we always get. I'm going to go back to your scenario. I bought a warehouse for $1 million. I sold it for $2 million. I 1031 into my retail shopping plaza for $2 million bucks, and I want to refi it, and I want to take some cash out on a refi, because we normally know that the cash out refi is not taxed. What are some of the rules around that, and some
you
of the
do have to be wary,
considerations that
because
people
number
need
one,
to
you have to find a
be
bank
wary of?
that will that will lend against that. First of all, you'll get, and that's certainly doable. But you also have to make sure that you get a proper kind of letter ruling, because there, depending on how strict or how conservative the interpretation from the IRS is, if you're taking anything out of the deal, it can sometimes be considered that you've taken boot out of the deal. So you have to be really buttoned up when you do that. It's doable. We see it fairly frequently. When we talk about DSTs in a moment, there's several DSTs that also allow for that. You have to typically wait 30 days before you can do a cash out and then redeploy those funds. But it's, I don't want to say it's rare, but I mean, we see it, but I wouldn't say that it's common.
Does it boil down to what is the intent? Because I know a lot of the stuff with 1031s, it boils down to what is your intent. So meaning, if your intent was to go refinance it and get cash out the whole time, as opposed to you just happen to wait and decide to cash out and refi, does that make a difference?
It makes a huge difference. And in fact, frankly, I should have mentioned that too, because the IRS, everything goes back to exactly what you said, David, is intent. What was the intent? I'll give you another example. Typically, if an investor has a investment property, they need to hold that. Let's say they found a replacement in an exchange. Typically, they should hold that for about 2 years before selling the property. That's kind of the rule of thumb or the best practice. However, there are a lot of examples where the individual sells in less than 2 years because circumstances have changed. Business or life circumstances have changed. Could be a divorce, could be a death, a business sale. The intent going in was to hold that property long term as a long term replacement. So that was your intent. Circumstances change, but the IRS will typically allow that because your intent was to hold for long term.
I've heard the alternative to that too, where I've heard the alternative to that too is a scenario
I'm glad
where
you mentioned,
somebody had
David.
purchased a property and they immediately listed it for sale. They owned it for about 5 years, but they tried to sell it the entire time. And when they sold it, they said, no, your intent was to not hold that property long term, and it disqualified their exchange.
Yes. Yeah. That's another perfect example of it. And we see that also sometimes with regard to individual homes, primary residence, because the rule of thumb, of course, is that you cannot replace a primary residence in an exchange. However, there's exceptions to that as well. We often see people, if they buy the place, maybe it was their intent to live there, they couldn't, they ended up renting the place for a couple of years. You've now established what was a residential primary residence is now an investment property. Your intent was for it to be your primary. Circumstances changed, and the IRS will often allow that. And by the way, this is the part of the conversation that I should probably say we are neither CPAs nor attorneys. So please consult. I know that's the first thing I'm supposed to say, but yes.
Well, 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 you guys will laugh. Is David knows this? The intro has that disclaimer in it, so, which David. So we actually have an intro disclaimer that has that exact. Because it's funny how often these conversations go down that road. Which you hit on something that I was actually going to ask you the reverse of, Dave, because I get to ask this question all the time. Again, I sold my warehouse for $2 million. I had $1 million basis. Can I go buy a condo in Naples with my $2 million in 1031 into it?
Yes, you can. You absolutely can. However, the easiest answer is if you're buying that strictly as a investment property and you plan to rent it out for the year, no problem. That's a replacement property. It's an investment property. However, if you're hoping to use it for personal use, typically the rule of thumb there is you can only use it for 2 weeks during the course of the year. Anything beyond that, or there's another interpretation, 10% of the days that you've rented it. But the rule of thumb is 2 weeks. You can use that property for personal use for 2 weeks, rent it the rest of the year, and then you've established that as a investment property. Yeah.
Got it. Before we jump into the world of DSTs, I want to hit on one more tax code because I think this will be important. That a lot of people have heard of 1031s. A lot of people have not heard of 721s.
Absolutely. And we'll get into
could you talk a little bit about
721 exchanges? Because that's a different path. But one alternative to kind of the standard 1031 exchange is that if you take your investment property, investor that owns a property, and if they were to sell the property itself directly to a REIT, to a real estate investment trust, public or private, that then triggers the 721, meaning it's not a taxable event, similar to a 1031. It allows you to sell your property and deploy your funds into the REIT. So now, rather than buying a specific replacement property, you now own shares of the REIT. Now, typically you have ownership units for the first year, and then after a year, you have the right to exercise those operating units, OP units, into common shares of the REIT. The advantage is you would now then have a diversified replacement portfolio of shares of that REIT. And again, it's still not a taxable event. So you've still deferred your capital gains. You now have shares of the REIT. They are liquid. You can sell them as you wish. However, when you do liquidate, when you do sell shares in a 721, that does trigger a taxable event. So you can go into the REIT typically, but once you're in the REIT, you're normally going to want to hold those shares in that REIT unless you want to trigger the taxable event. So, I'm sorry, you're going to say so, Brad? Yeah.
I was going to ask you a question too that we've dealt with when some 21s. If let's just say for simplicity's sake, I have one property and I put it into a REIT and I get operating units and I 721, it's a non-taxable event. And then that REIT subsequently sells that property.
REITs typically will have a hedging strategy that will prevent that from triggering an individual tax to the investor that originally donated or sold that property. Short of that could trigger a taxable event. The investor needs to be aware of that. If no accommodations are made, what you just described could trigger the taxable event. But most of your kind of larger real estate trusts, that's not uncommon. And so they will make accommodations to prevent that, typically through different hedging strategies that they would.
So when you go to set, let's say in this scenario, you have 10,000 shares of this REIT and it's to replace that $2 million and you go to sell 100 of those. I mean, you're not getting, you're having to pay, I guess, that pro rata share, going all the way back to your original basis, right? I mean, that could get complicated.
It can. You certainly do need a CPA that is very familiar with your basis, because within the 721 structure, I probably should have mentioned this as well. most CPAs, I say most because, again, this is sort of one of those gray areas, but the most common interpretation when you're in the 721 is that you do have the ability to sell your basis, to take your basis out without triggering a taxable event and just leaving your gain in. Unlike what I mentioned earlier with the standard 1031, you're deploying both and leaving both in the replacement. In the 721, once you're in the REIT and you have common shares, the best practice or the most common interpretation is that you can take out your basis at that point and just leave in a non-taxable event and leave your gain in. Again, please consult your CPA, but that's
Sure.
That's an
So
advantage.
you would keep your basis, and it should not be a taxable event.
That's correct. That's
and
a better
then
way of
when
putting
you
it.
settle the other shares, that's 100% taxable
You
at
got
that
it.
point.
That's correct.
Okay.
Yeah.
That's creative. I hadn't been through that, so I didn't know.
Well, we see that too. And Brian, I know we're going to kind of touch on the DSTs. There are some, maybe I'm jumping ahead, but there are some DSTs that have an exit, a 721 exit, where the same scenario where your DST shares end up becoming shares of the REIT, of the real estate trust itself. So we can get into that.
I think it's fun jumping into that. I mean, go ahead, Ron. I was gonna say, I mean,
Yeah,
so
you're hitting on it.
let's start back at that. I mean, how do you know, how does
let's do it.
the DST provide the
So, yeah, if
alternative
you wanna-
to someone with this scenario? They need to do an exchange for some reason. They can't find one, or they
Yes.
just don't want to. I mean, explain how you guys come in.
Absolutely. And you've described it perfectly. Those are sort of the two scenarios. So I always say that once an investor has sort of decided that, for the reasons we've sort of already discussed, they do want to execute an exchange. They don't want to pay the taxes. They want to defer the capital gains. Great. They've decided to do a 1031. I always like to say there's sort of a fork in the road. Maybe the more common or better known replacement strategy is you just buy another property. You sell property A, you replace it by buying property B. And that's fine, very common. However, for the two reasons that you just said, David, the first of which is maybe the investor just can't find a replacement property, or more commonly in our world, they don't want to find. They're looking for a more passive replacement. They kind of wanted, the expression I hear is they want to retire from being a landlord. Well, there's a more passive investment structure called a Delaware Statutory Trust. The acronym, of course, is DST. And the DST structure, it's been around for 40 years. It's been around since the 1980s. Originally, the DST structure had nothing to do with 1031 exchanges. It was just a business trust. It was a way for multiple investors to pool their assets to acquire and purchase a much larger property than what they could have purchased on their own. Well, in time, the question sort of came, well, wait a minute, can we use a DST as a replacement under the 1031 umbrella? And about 21 years ago, the IRS said yes. In 2004, they blessed the DST structure as a qualified like-kind replacement, meaning now investors, rather than buying a property directly, managing it, and dealing with all the hassles of direct management, they can have a more passive replacement where they are a partial or a fractional owner in a much larger property, and that property is structured as a DST. The Delaware Statutory Trust, that's simply the legal wrapper around an investment property. And so it allows investors to find what are typically Class A properties, they're institutional quality properties that satisfy the like-kind replacement requirement, but they're already in place, they're already being managed, they're cash flowing, and they're typically we use the term sponsor. They're typically sponsored by very large commercial real estate firms, or in many cases, private equity firms, billion-dollar firms that are buying these properties, structuring them as DSTs, and then making them available to 1031 investors. So let me pause there. I'll get long-winded on this, but I can keep going on the DST structure if that works.
I mean, that makes sense. I mean,
yeah. Well,
Brian, did you have anything specific?
I would add, no.
No, I love it. Keep going. I can go into the weeds on this with you, so I love talking about this.
I think the advantages, and again, I'm always careful not to say right or wrong, good or bad. It's a different structure than the direct ownership. But
everybody's scenario makes a difference. Their situation makes a difference.
you got it. Every scenario is different. We just present this as an option or a solution to the investor, but it's a very easy solution. And quite frankly, when people go into the DST, they typically stay in that structure for the reasons that we're kind of discussing. So it's very easy. You can typically close on a DST in less than a week. So the closing is typically simple. They're professionally managed by, again, as I mentioned, very large commercial real estate and private equity firms. You've got professional management. You also have the ability to diversify because the DSTs, as you would imagine, they are in different asset classes and sectors. So, an investor may prefer a industrial property in a DST or a multifamily property or a retail property or, a healthcare or a storage, et cetera. So it allows the investor to sort of diversify and lower their concentration risk, because if we're working with an investor that comes to us with $2 or $3 million to replace, well, rather than placing all of that into one property, which they could, but that would never be our suggestion. We'd say, hey, split that up. Why don't you blend that into, 3, 4, 5 different asset classes? You get it kind of like building a stock portfolio. You wouldn't just, buy one stock. You'd want to have a diversified portfolio. Our view is it's kind of the same way. If you want to go into the DST, you now have a blended portfolio that's cash flowing immediately. Ideally, and typically you do see appreciation because, these properties, typically are going to appreciate. You're going to see growth, and the investor will participate in that. And normally it's around a 5 or 6 year hold, sometimes less, sometimes more. But eventually the underlying property will be sold, and at that point, the individual investors, they also participate in any gain. If you own 1% of the DST, you get 1% of the upside. So it can.
So what happens in that scenario when you sell a property? Do they just roll it into another DST that usually with the same firm, or what happens then? I mean, they can choose to cash out, I guess, and pay tax.
All of the above, everything you just said. You would have the same options then that you have today. You can, most investors just do another 1031. You may see some investors do multiple 1031s over the course of their lifetime. So they can redeploy either into another DST. They don't have to stay in the DST. They could buy another replacement property. Or as you said, they can always just bite the bullet and pay the taxes. So they'd have the same options then, but the investor needs to go into the DST, knowing a couple of things. And first of all, they have to be an accredited investor. To invest in a DST, you must be accredited, meaning at least $1 million in net worth, separate from your primary residence. Secondly, the investor needs to know they are a longer-term illiquid investment. As I mentioned before, most of these you should go in anticipating you're going to be in this for 5 or 6 years. Now, some of the DSTs are earmarked, as we were talking earlier about 721. Some of the DSTs, their exit will be acquired by a REIT in a 721 exit. Those typically have shorter duration. That might be a 3 or 4 year hold. The more standard DST is going to have, or is going to see the underlying properties eventually sold, typically to an institutional investor, at which point the investor will have the options that we just discussed, do another exchange or cash out.
So what happens if, because again, every scenarios are different. Somebody gets into the DST and they have, a life event that happens and they need to liquidate. Is it possible? Is there, repercussions for that? I mean, can you explain that?
Sure. So investors should always go in anticipating it being illiquid and long-term. There's not a defined secondary market. And now investors, you're allowed to sell your position, but there's not a easy defined exit. So if an investor goes into a DST, they should anticipate being in the investment until it's eventually liquidated. And it's illiquid, and that's intentional. We don't look at that as a pro or a con. It's illiquid because we want to give the property time to appreciate. So if an investor on the front end, if they feel they want to take some cash off the table, Brian, like you had said earlier, you gave that example. What if someone wants to take $200,000 out of the deal? That's fine. We see that frequently, but the investment into the deal, they should expect it being in there. for the
But
duration.
but they could sell it to somebody else. It's just there's no market for that,
That's
and
right.
so there's really no way to define the value of that or how. I mean, it's just what do two people come up with?
That's
And I would
correct.
assume at that point they're gonna if there's, I mean, depending on what they sell it for, they're gonna have some sort of gain or have to pay something.
That's
I would
exactly
imagine.
right. Yeah. And so in this, just kind of as a side note here, I mentioned at the outset that I represent a firm called Perch Wealth. And this really goes into one of the primary functions that our firm plays in this structure. So, you know, in order to offer DSTs to investors, we have to be securities licensed. So even though this is real estate, we have to have our Series 7 securities license. So the broker dealer we work with is Rialta Equities. Within Rialta, our group Perch Wealth, we are 1031 specialists or real estate advisors, meaning two things. On the front end, we kind of help investors put a allocation together. We introduce different ideas to them, set up the brokerage account. And again, I like to joke we're sort of one trick ponies, even though we are securities licensed financial advisors. We strictly stay into the one lane. That's the securitized 1031 exchange. So that's half of what we do. Probably equally important is the vetting and the due diligence on the DST sponsors, because at this point, there's probably 80 or 90 firms, maybe more, nationally that are buying properties and then structuring them as DSTs. From that universe, there's probably 15 or 20 firms that we feel comfortable recommending based on history, track record, management style, exit strategy, all of that, before we would ever recommend a DST, because that's sort of our role as the specialist or as the advisor.
So that brings up a good question that I had. So what does it take for someone to start a DST? And I ask that because you say it's larger investment firms, but can a smaller firm start that? And people need to be wary of that because they're not as big. I mean, just like the QI is a good example. From at least it used to be. I remember back in 2009 and 10, there's several people that went out of business and people lost a lot of money because there were no requirements to be a QI. I mean, you basically just open an escrow account and you could do it. What's the difference, like with a DST? I mean, what are the hoops that companies have to go through to start one?
Yeah, so you're exactly right. The barriers to entry are not necessarily that great. If a few individual investors got together, they could buy a property and then structure it as a DST, the Delaware Trust. And the Delaware piece to this, that's just Delaware is a sort of a business friendly and a trust friendly state. They could do this in any state. That being said, we certainly would not have a comfort level with sort of a new, spawn. Not that they're not a good spawn; they may be great, but they just don't have a history or a track record, because you do have to. These are private placements. You do have to present a PPM, a private placement memorandum, listing every risk and reward and fee and strategy available. I always joke it's about 250 pages of light reading. Any DST that is presented must be accompanied with a PPM, a private placement memorandum. And so, sort of from that, at least from our firm, from Perch and our broker dealer Rialta, we're only going to have a comfort level typically with a firm that has done this. It has a track record a few times. That new firm that just creates that first, their first DST, we'll certainly watch that and monitor it, but we're not going to be comfortable offering that quite yet. Sort of the larger firms, some of the names in the industry, kind of the larger groups, typically billion-dollar firms. You'll see Inland, you'll see NextPoint, Exchange Right, Cantor Fitzgerald, Peachtree Capital. These are large, substantial firms with billion-dollar portfolios. Those are the firms that we're comfortable with. But what we typically won't do, as I mentioned earlier, is try to just put everything with one sponsor. We do want to see diversification.
What are some of the fees that some of these DSTs, have in deals? I mean, because obviously that can make a big difference on somebody's return and what they're doing. And obviously a bigger company that has a track record can charge more fees than a small one, but what are just some typical fees?
Yeah. And by the way, that's also when I mentioned earlier, some of the things that we look at from a due diligence standpoint is the fee structure. If they're an outlier, we're likely not going to work with them, because the way the fee structure works, and this is true of all of the DST sponsors, they will literally build the fee into the DST. All right, well, what the heck does that mean? What it means is typically when the sponsor firm buys a property, let's say they buy a property for $40 million, they will raise more than $40 million from the 1031 investors. That markup or that load will cover all parties. So if they buy it for 40, maybe they're raising 43 and a half or $44 million from investors, meaning that covers all parties, the sponsor firm, their managing broker dealer, third-party distribution firms like Perch and our broker dealer is all included within that load or markup. Well, what it means to the investor is all of their funds go to work. If an investor comes in with $1 million, their full $1 million goes to work. That's what they see on their statement. Their income is based off that number. But obviously that load or markup, then the anticipation is that over the course of the DST, the sponsor will be able to make that up and ideally more than make that up on the back end. Similarly, so my point there is I always use the expression, there's no haircut. And the investor puts in $1, they see $1. Then on an ongoing basis, of course, there's property management of the property. And that is also built in and netted into the fee. So in other words, if a DST is quoting 5.5% income, for example, that's a net number. The management fee has already been netted out, as has insurance, maintenance, and all of that. So I like to say the fee structure is clean, but obviously the fee structure is still in place. But by clean, I mean you're not the investor is not seeing a haircut or getting a bill.
But are there average or kind of market standard fees for, call it, the acquisition fee, the asset management fee, the portfolio management? I mean, are there things like that, and what are they?
Yeah, the upfront that we discussed, you're typically seeing those usually around 8.5 to 9.5% is sort of the upfront, the load or the markup, and then the ongoing management. And again, these will differ from firm to firm.
Sure.
Typically, it's going to be around 2 or 3% will be kind of the ongoing management fee, and that's of rents of the rental payments. And then on the back end, you do typically see a disposition fee. On the back end, it will also differ by firm, might be 1%, 1.5% on the back end as well. And those
are any ongoing like asset management fees, property management fees. That's something.
Yeah, the property
we see all the time. But
I'm sorry. Yeah, the property management and the asset management fees together. That's what I was saying, kind of on an ongoing basis. Okay. You'll see those combined to be typically around 2 or 3%, and that's already kind of netted out of the income.
Makes sense.
Yeah. The other. Yeah.
We've covered a ton of information. I mean, I was like, I think I just learned about 3 years worth of information in about 45 minutes.
I keep mentioning, I don't mean to go overboard with the whole diversification concept, but the reason for that, of course, is different sectors have different characteristics. Of course, the income is going to be based on the cap rates and the cash flow from the properties. And so, by blending together, not only are you getting kind of diversification of asset class, you're sort of getting that blended income as well, because, right now we're seeing a little lower, cash flow with sort of multifamily and self-storage, for example. We're seeing those typically, cash flowing in the 4s, retail, industrial in the 5s, a lot of hospitality in the 6s. And so we'll blend those together. The highest income we're seeing, believe it or not, you can invest into oil and gas royalties, which has by far, at least in our world, has by far the highest income. Certainly would not over allocate there, but to kind of give a little bit of a boost, those are yielding right now around 8 to 9%.
Wow.
And those actually, I know we're speaking mostly about DSTs. The oil and gas interests are structured as LLCs, but they are also considered like kind because you actually own the property and are leasing out the drilling rights to the different.
So I can sell an apartment complex in exchange into oil and gas rights?
Absolutely.
I didn't know that.
Yeah.
I'm in Oklahoma. I should know that. We got a lot of oil and gas.
Yeah. It's a great, yes.
And Dave, you mentioned that was the cash return. That doesn't take into account appreciation or everything, does it? And I know past performance is not indicative of future, but can you kind of give us an idea of like what that total like cash return, appreciation,
two
what that kind of looks like on an
to
annual
the return,
basis, just as an idea?
You've got the cash flow that starts immediately. So a 1031 investor in a DST is going to start cash flowing literally the first month. They'll get a prorated amount, from day one. That's where, depending on the blend of income right now, we're probably seeing in the mid to high 5s. That's your ongoing income. Then eventually, let's say in year 5, the portfolio and the prop. And by the way, some DSTs have one property, other DSTs have multiple properties within the same DST. But to your question, when the property is eventually sold, if there is growth, upside, appreciation, that is shared with all of the investors. And so you have a total return. I would say historically, your total return, on average, I'd say 10 to 11, 10 to 12%, with, roughly half that being income and the other half being appreciation. Is that realistic today? I'd probably argue it's lower. You'd probably expect a little bit of a lower total return right now. But I do think you still should expect to see some appreciation. Now, that will, of course, differ by asset class and location of the property, but that's what we've seen historically.
Is the cash flow paid in dividends, I assume?
So, yeah, it's a great question, David. The cash flow, it's paid monthly. It's taxed as ordinary income. The investor will typically get either a 1099 or what they call a grantor letter at the end of the year. And very importantly, that income, as I mentioned, it is taxed as ordinary income. However, there's typically a tax advantage to that income, because the management, the sponsors of the properties, they're typically passing the depreciation through. They are depreciating the underlying properties. And in many cases, they will accelerate the depreciation. In some cases, they'll do a whole cost segregation, cost seg analysis to sort of front load that income. So,
the investors are getting that.
You got it. That's it.
Yeah. No, that's a big.
And we're going to have to do a future podcast. Dave and I talked about we currently have a new tax bill, and now we have 100% bonus depreciation and 179, which could accelerate that
that'll
even
be a great
further,
conversation for the next time.
or front load that even further.
Dig into it. I love my kids joke. I find all this fascinating. I know it's a very narrow niche. It's a very, I joke, my, kids, well, what does your dad do? Oh, he's a 1031 exchange specialist. The heck is that? So, but it's,
we don't get invited to career day at school, do we?
Yeah, it's not that exciting. I love it, but it's, it's.
Dave, a couple more questions, I guess, on DSTs is, one, do they have debt on them? Right. So that I think that, because we talked about replacing debt.
I'll work backwards.
Two,
no capital calls.
Could you be subject
DSTs.
to a capital call?
They're not a lot like you'll see those in other types of investments, private equity investments. There are no capital calls in a DST. Now, so typically the DST will have a reserve fund. When they're raising that money at the outset, I was mentioning, the upfront load. Well, part of that is going towards reserve funds if there's any minor improvements, or if there's debt, which we'll talk about now, for any backup on capital. So you'll see that reserve. Typically, that's returned to the investor on the back end if it's not used. But the short answer is no capital calls. As far as
not allowed, or just not typical?
It's not allowed. Yeah, within the DST structure, you are not allowed to have a capital call.
So what happens? I mean, if it's just mismanaged and something happens and they need capital, though?
Yeah, then you'll have a problem property. You'll have a problem DST. So they will raise, part of that upfront markup or load is the reserve funds for any minor improvements. But you are not allowed to refinance. You can't have capital calls. You can't have any major improvements to the property. So that's why you do want to work with a sponsor that has,
so like you guys to do the due diligence and figure out that stuff ahead of time.
Absolutely.
That's important.
It's very important.
Because I'm sure it's happened at some point. Somebody did a DST and didn't know what they're doing. I mean, does it go into a receivership or foreclosure, or how does that?
Yeah, it would
be process.
Sure. Well, two things could occur. Number one, if cash flows impacted, and that goes to who are the tenants in the property. You're always looking at, well, what's the risk here? I'd always say the property risk and the tenant risk. So you want to know who the tenant is. If it's a retail deal, is it corporately backed? If it's a multifamily or a storage, what are the demographics in that area? That's backing that up. But then to the so that's the cash flow, and then to the property value. If it was mismanaged, I mean, it could result in the value of the property coming down. Like anything else, you cannot guarantee total return here. We can show you what the track record is, but it's like any other real estate investment. We can't guarantee that piece. Which again,
sorry, I didn't mean to cut you off. Brian
no, it's a great question. That I would spin that and just say that's why the importance of the due diligence on who are the sponsor firms we're bringing in. And then Brian, to your question on debt, this is very helpful. So, I'd say probably half the investors that we work with have a mortgage to replace. They sell a property and they have whatever the amount is. They pay that off at closing, and as we mentioned earlier, they have to replace all of the equity and all of the debt. Well, in the non-DST world, if you're just to do a standard 1031, you're going to have to go and get another mortgage or come out of pocket, which is not really a good solution, but typically you'd be getting another mortgage. With the DSTs, roughly half of the DSTs already have in place non-recourse debt that was put in place by the sponsor. So, if we're working with a Next Point or a Peachtree or an Inland and they buy a property, let's say they buy a property for $50 million, they might put $25 million in cash and they may finance the other 25. Well, that's 50% loan to value. Well, what does that mean? That means the investor that puts in $1 gets $2 of real estate, meaning a DST can allow the investor to cover their debt without going and getting another mortgage. Can be very, very helpful to the investor. Now, a lot of the DSTs have no debt because, we see some investors that have no debt. So we could, you can be in a 0 loan to value DST, or you can be in one. I'd say on average, you're seeing around 40 to 50% loan to value. But again, the sponsor is the sole guarantor of the debt. That's who the bank underwrites, and the investor, it's non-recourse, but they get the benefit of that debt in the DST.
In working with like someone like you, Dave, like you have access to multiple, you could actually create that blend. So let's say I needed to replace 36.8% of debt, right? You can actually look at the different things that you have and through different allocations, you can blend it almost
as you
to the
said,
dollar.
we can literally
if it made
dial
sense,
it down to the nickel,
right, in the investment profile.
If somebody wants to, if they have to replace an odd amount of debt, we would blend multiple DSTs and we can get to whatever number. You can always add debt. You just don't want to have less debt. If you add debt, and believe it or not, some investors go into DSTs that have debt because they actually want to add additional basis to depreciate again. You got it. So we see that, but yeah, that's
for the
short
depreciation.
answer is yes. We can dial it down to the nickel.
Well, Dave, I think we're going to have to do a part 2 of this because there's more, so much more. So I think maybe we put this out, get some questions, and maybe do a part 2, dive a little bit deeper, do a mailbag. But a couple things, on you is, where can listeners find a little bit more about you? Website,
absolutely.
email.
Well, first of all, I'm
give
on
us a little
LinkedIn.
information on you that we can kind of pass out there.
Dave Bulger on LinkedIn. My email address is dbulger, BULGER, at perchwealth.com. Perch Wealth is the firm that I represent. We're out of Southern California, San Juan Capistrano. So I would say through either email or through LinkedIn, you'd have access to my information. Yeah.
Perfect. And then
Yes.
we always like to end with a little bit of a fun lightning round. So it's kind of like, so what do you do for fun when you're not poring over 1031s and 721 tax codes?
Well, I mentioned we live in Florida. My wife Adele and I, we've been married for 28 years, 29 next month. We have 3 kids, and our kids are all tennis players. They love to play tennis. So I'd say that one of the first things we do is we watch a lot of tennis with our kids, our son and our 2 girls. They all play competitively. That's been a whole lot of fun for us. We do a fair amount of travel as a family and have for years, both domestic, and we've had some pretty, exciting international trips as well. So that's a big part of what we do. I'd say exercise. I like to run. I also enjoy golfing. I'm not a good golfer, but I do love to, I love to golf. And then I think I mentioned earlier, I'm originally from Pittsburgh, so I am still a Steelers fan. So I do get back to, back to Pittsburgh several times a year to see family and friends. Adele, her family are still up there as well. So we get up there often, and if I can piggyback it with the Steelers weekend, I typically will try to do that.
Okay, well, what's that? So when you exercise, you said you like running and stuff. What's playing in your AirPods?
Awesome.
Well, I still listen to the old classic rock, so I'm kind of a dinosaur when it comes to the music. So I'm still listening to Rolling Stones, Allman Brothers, Led Zeppelin. My newer music for me is like Guns N' Roses from the late '80s, but that's not a lot of the new stuff.
And last one I'll ask you is best
Wow.
book and movie
Well, books.
recommendation.
I guess
for the
most
listeners.
recently, I've been reading a fair amount of Malcolm Gladwell's some of his books recently. The tipping points, and I mean he's very good with trends, which is kind of interesting, and outliers. I'm partial to Michael Lewis. I've read a fair amount of his. I think The Big Short would always be a good starting point. Um, I think probably most recently, it's not even a new book, but the Who Moved My Cheese. I love that. It's all about adapting to change, anticipating change, reacting to it, not being overwhelmed by it. We see that in our business with commercial real estate, how sectors can kind of come in and out of favor, and you kind of have to be able to maybe roll with that. So, although I'll tell you what else, totally off that beaten track. I recently read the Roberto Clemente, back to my Pittsburgh roots. The David Moranis bio on Clemente was fantastic. So I'd throw that out there as a recommendation. If you're or even yeah,
That's going on my
yeah.
reading list. I hadn't heard of that one. I read all the ones you talked about
and as far as
before,
movies,
but
I
that will have to
see
go on my
far
reading
fewer
list.
movies now than
So.
than I used to. I used to go, and I was growing up a big Clint Eastwood and John Wayne fan. Again, dating myself, but I'd say more recent vintage. The Bravehearts and the Gladiators. I really enjoyed. I think the best movie I think I've seen recently was it's not new, but the newer Top Gun from a few years ago. I really enjoyed that. The Maverick. So those are a couple that are in
Yeah.
my wheelhouse.
Awesome. Well, Dave, thank you for your
Oh,
time
guys,
today. I'm
thank you
sure
so
we'll
much,
probably have to
Brian.
do this in a
Appreciate it, David.
follow-up.
Thank you so much, and
appreciate it.
appreciate being part of this and participating. So thank you.